Now, Co-operative Bank of Kenya emerged the overall winner in this year's Sustainable Finance Catalyst Awards organized by the Kenya Bankers Association. Equity Bank Kenya emerged second overall as Absa Bank Kenya came in third. Our very own Jimmy Mbogo was there and now joins us with more. Good afternoon, Jimmy.
Very much, Nakundi, and a very good afternoon to you too. Yes, as you rightfully said, this was the 7th edition of Sustainable Finance Catalyst Award. Just looking at how banks are conducting their operations differently, and there were about 8 categories that we have seen. One of them, of course, is being best in sustainable finance. We have areas such as most innovative banks. We have promoting people living with disability with access to different areas. And I'll just take you through some of the overall winners. At third place, of course, we have Absa Bank, which is the third place overall winner. At the second place, we have Equity Bank, and of course, the overall winner for this edition is Co-operative Bank, who have also scooped several other awards that I will be telling you later on in our subsequent bulletin. But for now, I'm joined by Dr. Habil Olaka, who is the CEO of the Kenya Bankers Association, just to help us understand in terms of opportunities in as far as sustainable finance goes, what more can financial institutions in the country. Dr. thank you so much for making time to speak to us. So let's just start from the beginning, which is the question of ESG and sustainability is sort of a new conversation into the market, and we're not seeing a lot of there are those who will tell you there's a lot of untapped opportunities in that space. So what more can Kenyan banks do to prepare themselves in tapping into these opportunities?
Yeah, I think the whole thing links to what we can term as a sustainable development. Because for sustainable development, you have got to ensure that the financing that is financing that development has also got to be sustainable. And that's why we took the effort right earlier on in the beginning to ensure that we create this sustainable finance initiative to assist the banks in terms of making themselves sustainable. And that sustainability is not only in terms of their practices, but whom they lend to ensure that they are lending to sustainable businesses. And therefore, we have been creating capacity in the banking sector to ensure that banks are aligned to their sustainability goals. Now, in order to encourage the banks to showcase what they are doing, we then created the Catalyst Awards. The Catalyst Award that we are having today. This is the 7th edition of the Catalyst Awards. And what you have seen come out of it is the fact that banks are now becoming aware. They're beginning to demonstrate the fact that they are actually incorporating sustainability guiding principles in their practices. So what they were showcasing here today was what they have done. And those that came out best were the ones that were being recognized amongst their peers in terms of their practices, in terms of their lending practices. And so when you talk about sustainability, you're talking about the environment, you're talking about the social pillar, then you're talking about the governance pillar, and of course the overall contribution to the economy in terms of sustainability.
Banks are in the business of lending, so how then do they balance between profit and impact?
That's the whole idea behind the Sustainable Finance Initiative. You see, the whole idea was the fact that banks should not just focus on the profits, because the assumption was that you can get profits at any cost, which means that you're not bothered about the impact that your lending has on the economy, as long as you can make your profits. But that's more or less short-term in nature, because if you make profits today, and you don't create an environment where you can sustainably make those profits into the future, then tomorrow you'll be dead, you see. But by sacrificing part of the profits that you can make today in order to create an environment whereby these profits can be made sustainably into the future, and that therefore means that sharing it with others. So you sacrifice part of the profits so that somebody else can also make an opportunity so that they can have their livelihood also taken care of.
In as far as sustainability goes, banks are still sort of struggling with these metrics and finding a metrics that then, because when we talk about impact, it's not something that we can assess and say that there's X percentage of risk that then we have to deal with. So how are you helping banks to come up with the metrics in terms of, even as you look at the impact, you're also looking at these are the potential risks going into this project?
Now, there are a number of metrics that are available, globally. But I think the ones that have really come up and we are trying to support banks in terms of aligning, we have got, for example, the task force, climate-related financial disclosure. That's a task force that is trying to create a matrix in terms of how to measure yourself in terms of compliance, in terms of your climate-related risk management practices. Now, and there is also another second one, which is called the Task Force for Nature-Related Financial Disclosures. Those two are intertwined but distinct. So if you look at the nature-related financial disclosures, they incorporate almost all those that are linked to the climate-related financial disclosures. So on the climate-related financial disclosures, they already have a template. What you have done is that Central Bank has issued guidance on climate-related risk management, and they require the banks to disclose their operations in terms of risk management and in terms of their practices. Now, because that's required by the regulator, we have then assisted the banks to come up with a template that will help them report to the Central Bank in a uniform way across the whole industry. So that's one way of supporting the banks to ensure that they are disclosing their practices. Then there is the other one I mentioned about the task force on nature-related financial disclosures, for which there is already work that is going on. They released the recommendations just the other day in Nairobi, about 2 weeks ago. And our role now will be to support the banks to align themselves in terms of disclosure in line with the task force recommendations.
Sorry, lastly, before I let you go, and away from the catalyst and sustainability conversation, we're almost at the tail end of 2023. Now, one of the biggest conversations that has been that has cut across the year is the question of interest, and particularly in as far as volatility is concerned. That has been one of the biggest talking points for bankers, not just in Kenya but globally. So, as we come to the end of the year, how well are banks prepared going into the next year, and what are some of the trends that you see changing, particularly in that interest rate area?
It's an interesting area because it's an issue of a balancing act by the players, by the regulators, because the regulator, for example, and by this I mean the Central Bank, under its Monetary Policy Committee, they review the developments in the macroeconomic environment and then give guidance in terms of which direction the interest rates should be moving, for example. Because what tends to happen is that inflation is the main enemy, so to speak, and therefore they'll try to ensure that they conduct their monetary policy in a direction that is stemming the inflation. So if inflation is spiking upwards, they will also try to raise the interest rates to tame the inflation. But they also have to be conscious of what the other global players are doing in terms of the same area, you see, because it also affects the exchange rate between our currency and the developing markets. So if Central Bank then decides that the right way to move is to increase the interest rates, you'll see the interest rates in the market increasing. Banks, in terms of transmitting that monetary policy, will transmit it into their credit portfolio. So you see the interest rates in the market beginning to rise, but also deposit rates in the markets rise. However, that is not a conducive environment for growth. So you're sacrificing growth in order to achieve macroeconomic stability in terms of price stability, because inflation going up means that prices are going up. Once you have tamed inflation and you are well anchored, then you can now start reducing the interest rate in the market to stimulate growth. And what I'm seeing happening possibly that there might be that volatility, the interest rate may go up, but eventually once you have tamed inflation, the rate starts coming down. Once rates start coming down, you start stimulating growth by allowing more borrowing by the productive sectors of the economy, and therefore achieve the growth on a more stable, low inflation base.
Thanks so much, Dr. And of course, I'm sure for many borrowers, they cannot wait for the time that interest rates will be coming down. But thank you so much for making time to speak to us. And of course, there you have it, Nyakundi. We'll be try and speak to some of the winners, just to get their sentiments about what these awards mean to them, and what are some of the things that they have gotten right to be able to earn this award. But for now, back to you.
Right now, the rise in tourism numbers has continued.